People blame the Fed and they say, well, if the Fed didn't do what they did, and if the government didn't spend the money they spent, we'd definitely be in a recession right now. I agree. But the Fed did do what they did. The government did spend what they spent. Hey, finance fam, the end of the year is here. 2022 is coming to a close, and a lot of us are still asking the questions: what the hell is going on with the stock market? Where are we going from here? Are we in a recession or are we not in a recession? So, I'm going to go through a lot of information today and give you my opinion and how you can prepare going forward into 2023 with investing the best way that you can for your goals in future. So let's start with the Federal Reserve. So for those of you who don't know, the Federal Reserve is responsible for monetary policy. This is a fancy way of saying they are responsible for raising and reducing interest rates to control demand in the economy. They'll raise interest rates. That's why we're seeing the Fed do what they're doing right now. That's why we've seen the real estate market pretty much come to a standstill. We're finally starting to see a lot of the froth in the real estate market come out because the Federal Reserve has raised interest rates, which is going to decrease demand for houses. Does that mean that we are in a recession right now? Well, let's dive into some data and I will get to that. Okay. I put together a fun slideshow for all of you. Let's start with what the Federal Reserve has done and what the future looks like according to the Federal Reserve. So in September of 2022, I have the dot plot here on the left, and I also show the dot plot in December of 2022 to show you the comparison of what has happened. So the dot plot is essentially released when the Federal Reserve has their meeting and they are making interest rate decisions. And what the dot plot does is it gives us an idea of where interest rates are expected to go in the future. In September of 2022, we saw the peak interest rate happening in 2023, and you can see that by this highest dot here. Many participants in the Fed had a consensus that we were going to see rates anywhere from 4.5 to 5% peaking in 2023. And now we move over to December of 2022, and you'll notice that in 2023, the peak rate is a little over 5.5%. Okay, so a little bit higher than September. So you kind of saw this dot plot shift up. But what I think is very interesting is the similar long run view that the Federal Reserve sees. So, over the long run, the Federal Reserve is agreeing that we're going to see interest rates settle between 2 and 3%, which is a low interest rate. And I'm actually kind of surprised that over the long run, the Fed is settling in that 2 to 3%. So, they agree on that. But what the market and the Fed doesn't agree on or can't quite figure out exactly how it's going to go is the highest interest rate that we're going to see the Federal Reserve hike to. Is it going to be 5%? Is it going to be 5.5%? Is it going to be higher, 6%? We don't know what that capped rate is going to be. And then the second thing that we can't quite figure out here, and there's a lot of nuance in the middle, is when the Federal Reserve is going to start to decrease interest rates again. There's also a possibility that we do end up seeing a recession and the Federal Reserve is going to have to uh, decrease interest rates quicker than they expected. So I think that's what the market is thinking. The market is basically saying, we're calling your bluff. You're going to have to decrease interest rates quicker than you think, than what your dot plot is saying. And that's what the market is saying. And the Fed is saying, we are going to do whatever it takes. We're going to keep interest rates higher for longer. We have a long way to go to fight inflation, yada, yada, yada. And so there's this like disconnect between the market believing what the Fed is actually saying. So what this tells us is the Fed is willing to shift gears and change their positioning if they have to, because they've done it. We've seen it. So what about the consumer? I mean, how is the consumer faring through all of this coming out of the pandemic and where we are today? So the unemployment rate is one of the data points that the National Bureau of Economic Research uses to determine if we are in a recession or not. And as you can see, the US unemployment rate is extraordinarily low. We have a lot of people employed. Now, the Federal Reserve is expecting the unemployment rate to go up. The question is, can the economy just kind of stay stable and chug along and keep people employed? So, as you can see, this unemployment rate is definitely not flashing signs of recession right now. The other thing to kind of take a look at when thinking about the consumer and the labor market is how many job openings we have right now compared to people to fill those jobs. And right now, we are seeing like one of the largest gaps in the amount of people that are unemployed or taking continuing claims, and then the amount of job openings that we have. So, what that means is there are a lot of job openings right now and not enough people to fill those jobs. What that does is it keeps people employed, which keeps people making money to be able to pay their bills and maybe have a little bit of discretionary income on the side. In a recession, people are having a very hard time finding employment and they're having a hard time paying their bills. So this is definitely not where we're at in terms of looking at the data right now. Now, if you look at pockets of the market, the real estate industry is I would say in a recession officially. That's one of many sectors in the market. And the reason for that is because the Fed has raised interest rates so quickly. A lot of people were resigning, and we kind of had this great resignation that a lot of people thought we were in. People have plenty of options for job openings, so they were quitting their jobs. We're finally starting to see that slow down. So maybe we are not in the great resignation anymore. This is data from the Bureau of Labor Statistics, and this is a jobs report. And in October, the total number of separations basically changed little, like practically unchanged. And then the number of quits were little changed, so people quitting their job, and then layoffs and discharges changed little as well. So we're not really seeing a lot of movement, so to speak, in the labor market. We're kind of just seeing it stabilize, and people are just staying put because they're probably a little bit more afraid to quit their job going into a looming recession or a slowing economy, right? So maybe the labor market is losing a bit of their stronghold and their dominant position, but overall, I would say the labor market is still, even though there are some flaws in the data, which there are, but even with the flaws in the data, I would say the labor market is still very strong. So I was curious. I was like, well, okay, what kind of jobs are actually available? Because if it's service or lower paying jobs mostly, that maybe not be as great. So what I did here is I looked at the job opening categories with the largest numbers, and trade, transportation, and utilities. That was the first large job opening numbers that I saw. And then professional and business services, those are typically going to be well paying jobs. Professional and business services, those are typically going to be decent paying jobs, maybe even some high paying jobs in there. Education and health services, that actually had the largest number of job openings. Leisure and hospitality are going to typically be the lower paying jobs. I would say that it's a nice mix of a little bit of everything, and there are likely going to be some decent paying jobs that are in there. So let's look at delinquency rates because this is really what we want to be paying attention to. Credit cards delinquency rates have decreased over time, but the bad thing that we're seeing is they're starting to come back up because inflation is definitely eating into consumer pocketbooks. And that is the crux of the issue with the economy and if we're going into a recession or if we're in a recession or not. What I did here was I charted the 90-day delinquencies on US credit card accounts, auto loans, and mortgages. Now, what I want you to notice here is mortgages delinquent by 90 days or more has come in stunningly since the 2008 financial crisis. A lot of people also locked in 30-year mortgage rates at very low interest rates over the past few years. So that also helps people be able to stay in their homes. Could this tick back up? Absolutely. But I'm expecting this to probably stay at a pretty reasonable level going forward unless we have a really deep recession, which I don't know if I'm seeing a really deep recession in our future, to be honest. We'll get to that later, though. The auto loans delinquent by 90 days or more is way more concerning to me. A lot of people bought vehicles during the pandemic that were very, very overvalued, but they needed a car. They had to take out the loan. Now, what we're going to see is we're going to see a lot of people that took out auto loans be way upside down. It's pretty normal to be upside down on your auto loan to begin with because cars depreciate dramatically over time. But we are going to see that on another level, in my opinion, over the next few years. And so, what I am suggesting to people is you're probably going to want to stay in that car that you bought until the wheels fall off. You're going to have to ride or die that thing because you buying a new car anytime soon and rolling all of that negative equity into a new car, it's going to haunt you forever. So I think that a lot of people are going to be stuck with the vehicles that they have and the high payments that they have. But I think if we are going to see delinquency rates increase significantly, it's going to be in auto loans. The credit card delinquency rates, so 90 days or more on credit cards. This is actually interesting that it's still as low as it is. Like I showed you in the previous slide, we are starting to see a little bit of a tick up in delinquency rates from the Federal Reserve's data. But in general terms here, I would say we do have a ways to go until we see this become a big issue. I think it's important to look at this data in comparison to the 2008 financial crisis, and it just kind of helps to put things into perspective. I, when I look at this data, I say, okay, the consumer is actually in okay shape here. We do have room for things to get worse, but we're not maybe going to get to 2008 crisis type of levels or that type of situation, just for the simple fact that we are in a very different economy today, and there are a lot of moving parts that are different than what it was back in 2008 as well. So that's just my take on it. So here's what worries me is the consumer debt service as a percentage of disposable income. So how much in a percentage term is your consumer debt, meaning your credit cards, your private loans, think your auto loans, your consumer debt as a percentage of the income that you have left over after paying your bills? Disposable income is what keeps the economy going. And if consumer debt continues to increase as a percentage of disposable income, that is concerning, and it's happening right now because of inflation, because things are rising in cost and people are having to charge more to their credit cards. So we don't want to see this go up. We don't want to see this go up because that means consumers have less money to spend in the economy to make the economy grow. So that is why this is a very important data point to me. And what worries me is that this is going to continue to increase to a level that we really don't want to see, or maybe inflation will start to decline and the consumer will have a little bit more breathing room and we'll kind of see this level off. Inflation persisting will absolutely exacerbate this issue. And obviously, the inflation rate is still over 7%, slightly over 7%. Inflation is starting to come down, but it's still persistently high. But we're hoping that the peak is in and we're downhill from here. So, what is the biggest risk to inflation? What would cause inflation to go back up? Well, in my opinion, it is oil prices. So, oil prices are the big wild card right now because if oil prices go back up, what does that mean? That means everything else becomes expensive, right? Think about the gasoline that you put in your car. Gasoline has come down as oil prices have come down, but if gas prices go back up, there's your disposable income going into your gas tank, right? The other, unless you have an electric vehicle, I know. Higher oil prices are also incredibly problematic for more things than just you putting gas in your tank. Your utility bills, your cost of goods, because people have to transport those goods, right, from different places around the world. And what do they need to transport those goods? They need oil. Higher oil prices trickle down into multiple things in the economy. So, what could cause higher oil prices? Well, I'm no oil expert. I've listened to a lot of oil experts to try to get a grasp on what's going on and where people think oil is heading. There are a lot of people that think that oil is heading higher. The investment in the oil industry hasn't been there because people have gone, green or been trying to go green. So a low supply or low production of oil would be problematic for oil prices. That would cause, low supply. higher prices. Simple supply and demand. The other thing that could cause higher oil prices is China reopening. So China has been on lockdown, and China, you might be thinking, well, what does China have to do with anything? Well, we do have a global economy. We do have corporations in the S&P 500 in the stock market that have exposure to China to help them earn revenue and grow revenue, right? China is a pretty high growth market actually for a lot of corporations. It's not a huge percentage of S&P earnings, but it's definitely a nice chunk that if China does reopen and start to spend in the economy again, it could be helpful for some of our US corporations, in turn, helpful for earnings. But what it's bad for is they will be using oil, demanding more of it. So China reopening is definitely a wild card. So let's talk about where the S&P 500 is valued today, how that compares historically, and where I think the market is going from here. Price to earnings ratio is the major ratio that we use to determine if the S&P 500 is showing value or not showing value. We've seen S&P 500 valuations go very high during the 2020 pandemic. And then we are now recently seeing the stock market valuation come in quite a bit from around that 22 times earnings. And now I think we're sitting around, I think today we're sitting around 17 and a half, maybe closer to 17 after seeing the stock market sell off a little bit more over the past week. So we are definitely seeing more value come into the market, but we are not seeing recessionary valuations. So, a recession in 2008 caused the stock market PE ratio to get down to around 10 times earnings. That is extraordinarily low. If the market ever got back down to those levels, I would be backing up the truck buying. You can see that we're essentially hovering around the 25-year average PE ratio. Could we go lower in the stock market? Yes, we could. Do I think the stock market is cheap right now, taking into account the risks of recession? No, I do not think the stock market is cheap right now, but I also don't think the stock market is expensive either. And I also think that the outcome of what happens in 2023 and 2024 is so all over the place. I mean, there are so many directions that it could go, actually. I think a lot of people are very focused on one thing happening, and that's everything crashing, bear market continues, and the economy goes to crap. But when you look at the data, I can't quite get to the doom and gloom scenario of a 2008 style crash or a 2008 style recession. I think the odds are more likely that we'll actually see the stock market kind of chop around. Maybe we retest the lows that we had in 2022 and we kind of bounce in this range bound market environment. I think that that's going to be the more likely scenario because, again, if you look at earnings expectations for 2023, we're still seeing analysts expecting 5.5% earnings growth in 2023, which, if you think about it, that's kind of crazy because that's basically saying there isn't going to be, a recession, or if we do have a recession, it's going to be very mild and very quick, and it's going to end, and we're going to get back to growth in the back half of 2023. So analysts right now are basically saying the economy is still going to grow, earnings are still going to grow, but a lot of that growth is going to come in the end of 2023. Then you have people saying that's absolutely incorrect. We are not going to see 5.5% growth in earnings in 2023. We're not even going to see growth at all. We're going to see negative growth in 2023. Earnings are going to be negative, right? I think personally, the truth lies somewhere in the middle when looking at all of this. I think that we may see flat growth, maybe zero growth, right? We're flat. We're not seeing declining growth, but we just kind of hang along steadily and wait this out until the Fed decides to start decreasing interest rates again, right? So I think that the truth lies somewhere in the middle. And any growth that we see in 2023, I think will be a surprise to a lot of people, even if it's like 1% earnings growth. We're not hot, we're not cold, we're just kind of lukewarm. I think the other thing to consider here is how tight the labor market is. I think that and retirees possibly coming back into the labor force because of having troubles with living off of their retirement with the market being down, with inflation being high. We may have to see retirees come out of retirement and come back into the workforce. And what that could do is it could make retirees more comfortable financially, and maybe they will have a little bit more disposable income if they come back into the labor force. So that's also another thing that could be a wild card with keeping things kind of afloat and steady. I think accumulating risk assets, aka stocks, whether you're buying an ETF or individual stocks. I think a lot of stocks are showing value. I know that I'm still accumulating stocks because I do think that the outcome is so broad of what's going to happen in 2023 and 2024. I want to be prepared for both scenarios. I'm basically not ruling out the fact that the bottom is in the stock market. I'm not ruling that out, and I'm positioning myself to where I can be invested and invest in stocks now while valuations are coming in. And I'm also keeping some capital on the sidelines, that I'll have cash if we do see a recession hit and valuations take a major hit and see that PE ratio come back down to, I don't know, maybe the 12 to 15 range, somewhere around there. I would be very, very interested in buying more stocks for sure. I think preparing for both sides right now is the best bet. There's also the possibility that the consumer starts to feel more pain and we see discretionary income, decline more, and consumers aren't spending and they're having trouble paying their bills because inflation is just persistent as heck. And so that could be a risk too. So I'm investing, but I'm also keeping some cash just in case we do see the stock market come in a lot more. I also think right now your asset allocation is a good thing to take a look at and decide if you want to adjust. When assets are down, this is when you could possibly rebalance your portfolio, adjust your asset allocation to be more in line with your actual risk tolerance. So I think that bonds are a good thing to actually look at right now. And you could maybe take some of that risk out of your portfolio by putting some capital into those higher yielding bonds that we have right now that are pretty short term bonds. Okay, that was a lot. Okay, so my general overall thoughts, bringing it all to a close. Do I think we are in a recession right now? No, I don't. I think we're in an economic slowdown right now. An economic slowdown means people are spending a little less money. We're starting to see credit card balances rise. We're starting to see disposable income decline. The consumer's definitely feeling this, no doubt. But are we in a recession based off of the unemployment rate, based off of how GDP has acted over the past few quarters? I just can't quite get there that we're in a recession right now. That a lot of people disagree with me on this, and a lot of people blame the Fed and they say, well, if the Fed didn't do what they did, and if the government didn't spend the money they spent, we'd definitely be in a recession right now. And I agree. I agree. But the Fed did do what they did, and the government did spend what they spent, right? And so we have to look at the information that we have based off of what has happened. We can't pretend and play these games like, well, if the Fed didn't do this, then we'd be in a recession. Yeah, we would. And that's why they did what they did. So I try not to think too much about that and just look at what we've got and base my opinion off of that. Do I think that there is still a possibility of a soft landing? I think the Fed will be more flexible than people think. I think that they have changed their tune before, and we've seen that. And I think they would change their tune again, even through all of the tough guy talk. And I think that the market is clearly showing that they don't believe what the Fed is saying. And maybe rightfully so, because we've seen such extreme changes in their policy and their talk and their speak and their dot plots. I mean, we've seen it. So maybe that's why the market isn't actually believing what they're saying. Do I think the bear market is over? No, but I also see the possibility of the stock market just kind of chopping around in a range. Like maybe we don't see a huge 20, 30, 40% sell off in stocks from here like people are expecting. Is it possible? I would say yeah. but I think that it'll be maybe more likely that the market tries to hold up and chops around while it's waiting to see what 2023 is going to look like because it's so all over the map and uncertain right now. Do I think that people should be buying stocks right now? I think preparing for both sides right now because of the fact that the 2023 outcomes can be so all over the place. Maybe the Fed pivots and lowers interest rates in 2023. Maybe they don't. Too many variables. I like preparing for both sides by buying stocks now, and I can have some capital to allocate if we see the market decline further from here. So that is my opinion. That's where I'm at based off of the data that I've seen. I hope you find this helpful. If you did, if you liked this style of video, if you like me digging into the data and talking about my thoughts, please let me know in the comments. That'll be really helpful. Like this video if you learned something new. Subscribe if you're not subscribed, if you like learning about finance and the markets and how to grow your money the right way. We will see what happens in 2023, and I'll see you next time.